is the same reason I'm bringing this up. There's really two parts to this story. The other one is Carvana. This one had some short interest. This is a hated name. Another one was in an uptrend. Another one that had UOA. Another one that had a potential catalyst of the earnings reaction. And you can see on Friday, you close at 207.31, and then you trade up $52 on Thursday. So the reason I'm bringing these up is not because they may have been great scores for people. The only thing I'm bringing these up for are, one, when we start seeing things that are this stupid, that's often been a precursor to that the market is running out of its ridiculousness and you're getting towards an extreme. The public owns stocks like there's no tomorrow right now. That's also at an extreme. That could also be a problem. It has been historically. But when things like RDDT and Carvana put together such ridiculous moves, right, where one day you're trading for, I don't care how great the earnings were. As far as I can tell, they still haven't cured cancer, these companies, that is. And yet, right, they're trading as if they do, like the very next day. So 50% surges, to me, right, this is just market, not that I wouldn't trade it, but it's just market ridiculousness, market manipulation, people that are on the wrong side that are really having the screws put to them. This is not a $20 pop, right? These are extraordinary moves. For that reason, I've noted this in the past where things got utterly ridiculous like this, and that's often been your foreshadowing that, okay, the silliness in the market is so silly, that so many standard deviations from where reality lies, that it's gotten too insane. This needs to be curbed. There needs to be like a reckoning. So I'm not predicting that. I'm just telling you I've seen it many times, and just take it for what it's worth. Now, the other factor I wanted to mention on these two is that you have to respect the fact that this is when everyone's got this happening right early on. I'm not saying you shouldn't roll or adjust. I'm a big believer in rolling and adjusting. But what I'm trying to get out the message is that don't get caught up with a spread adjustment where, I want to sell these calls that I have, and then I want to I want to get into these simultaneously, where you're trying to execute on one options market and another options market simultaneously at a spread price. The reason I'm saying that is because you might not have a good market right when the stock opens in both contracts. And so if you have a wide market, you might not be able to get something done. And if you can't get something done and you miss your opportunity and they start really reversing things hard on you, you could shoot yourself in the foot. So I would just say, right, you're having a windfall, be willing to pay the additional charge in commissions to have a second order. In other words, priority one is capturing your profits by closing out your long calls, right? Just close those out, make your money. Then if you still want to be in it, get right back in it with something else, right? With another separate order, because this just isn't worth it. You can play games and these things do reverse, right? So sometimes that opening print is great and the stock just reverses from there. If you play games with that order, you can really get beat bad.